Hey, everybody. With us again is our financial expert, Mark Collinsworth of Vere Global Wealth Management, and the guy of the hour now, because we're going to ask him what happened to the stock market today. A huge drop, and then the Powell, the chairman of the Federal Reserve Board, made a significant announcement. It's all coming together, and it doesn't look good. So, Mark, tell us why the huge drop in the stock market today, and just how big was it?
Ooh, it was a fair. Thank you, Larry. It was a fairly large drop. The Nasdaq dropped 566 points, which is about 4.7%. The S&P dropped 4%, and the Dow, which lost a little bit over 1,100 points, was about 3.5%.
All right, so that is significant. Now, what caused that?
Well, it's kind of a two-part story. Yesterday, Federal Reserve Governor or Chairman Powell gave a speech at the Wall Street Journal. And in his speech, he actually said, we're going to keep raising interest rates until we basically get inflation under control, or said a noticeable decline in the inflation rate. And he also added, if we have to experience some pain to get there, so be it. And basically what that said is, what he's saying in between the lines is when he says, if it requires some pain, he means pushing us into a recession, maybe even a deep recession like they saw in the early 1980s, when they had the same inflation rate. And the market kind of didn't really pay a lot of attention to that. But what they did pay attention to was when Target, Target, the retail company, came out with earnings, didn't have a good earnings report, and they said they were going to have to raise prices. Well, raising prices, that's more inflation. So if Target's going to raise prices on its customers, that's putting the Fed even in a deeper problem of having to raise interest rates a whole lot more, which is just going to add to the misery that we're currently in if you're not in cash in the stock market like we are.
So everybody is kind of in a semi-panic mode at this point.
I wouldn't say we're in panic mode yet. The panic is yet to come.
But now Target says it's going to have to raise prices because they've been trying not to pass on price increases to their customers, even though it's more expensive for them to produce these products, to have these products available. But they were holding the line so far, but now they're saying they can't because the earnings have dropped, so therefore prices have to be raised in Target.
Correct. The profit margins are getting squeezed because if they were selling a widget at $10, it costs them, $10.50 to buy it on their end. They have to start passing that extra cost off to the consumer.
So I imagine those who participate in the stock market are saying, well, if Target's doing it, other companies are going to be doing it as well, correct?
That is correct.
All right, so Mark, how bad is this going to get? And again, my favorite question, how bad, how soon?
Well, this year, just because of the way the seasonal things lined up, normally this is a mid-year election, a midterm election year. So historically, the stock market drops in these years. It's normal to see a minor drop. Well, this year you've got the inflation problem and the Fed raising interest rates on top of all that. So it's kind of like pouring gasoline on the fire. So it's a little bit worse than normal. But I think what the scenario is going to happen here is that the stock market's going to go lower. The Fed at some point down the road in the next, 5-6 months is going to realize they now are going to have to start adding liquidity back in the stock market, because the U.S. stock market, the U.S. economy really is the stock market. And they realize how important a strong stock market is for the economy. They're going to basically try to jack it up again here in the next, 6 months, 12 months down the road. And I think that's going to kick off another bull market. The problem I have with that is you can't keep doing the same thing over and over again and expect a solution. And I think what you're going to do is you're basically setting up the stock market. Yeah, the stock market might run up another, after the Fed starts turning on the spigots, they may run it up another 100 to 200%. But all you're doing is you're setting yourself up for failure, because right now, a lot of people don't, unless you really study valuations on the stock market. And my favorite indicator is called the Buffett indicator, created by Warren Buffett, on when the stock market's overvalued, undervalued. Right now, the U.S. stock market would have to fall 50% based on that indicator just to put it to fair value, not undervalued, just fair value.
So therefore, in layman's terms, what does this all mean? First of all, adding liquidity to the market, that may be the first technique they use. What does that mean, adding liquidity?
That means the Fed is essentially, they are cutting interest rates and they're basically flooding the banks with free money, and all that free money that's going into the banking system is being issued out as in car loans, so people can buy cars, loans for mortgages, so people can buy houses to basically stimulate the economy and the stock market.
So wait a minute, you're saying then that they'll actually reduce interest rates, a reverse technique now, in not too soon a period?
If you raise interest rates, you're taking money away from the consumer.
And they've done that. They've done that already to a certain extent.
And they're still doing it and will continue to keep doing it.
Okay, so when are they going to reverse that to add liquidity, as you say?
Based on what I'm seeing right now, I don't believe they will start injecting liquidity back in the system until probably sometime early in the first quarter of next year.
All right, so in the meantime, then, we could expect more interest rate hikes and more inflation and more depression in the stock market.
Correct. The only reason right now, if the stock market thinks the Fed is going to stop raising interest rates, or if inflation is going to come down, the stock market will basically smell that a little bit ahead of time. So the stock market, a lot of people don't realize the stock market always looks into the future. So whatever's happening today in the stock market is really happening 4 and 5 months down the road in the economy.
So the way it's being read now is what? That it's going to tighten up now for a while, but early next year, it's going to start moving away from all that and headed towards another bull market.
Another bull market, and I think that will be your last bull market, because you just can't keep, because if you look at it this way, ever since 2008, or actually let's go back before 2008, what was the Fed's solution to a problem with the economy? You cut interest rates. Well, 2008 came around, they cut interest rates to zero. Cutting interest rates then no longer worked. Then they started doing the bond buybacks. They started going and buying bonds to try to save the economy. And they keep on having to buy more and more bonds every single time. So whereas the TARP, I'll give you an example, TARP only, when they injected the TARP money in 2008, that was about $700 billion. The Fed pumped $700 billion into the economy to jumpstart it to recover from the housing bubble. Now, to get that exact same hit from 2008, it now requires $6 trillion to get the same hit as $700 billion. It's the same thing as why people that are take drugs, they overdose because they have to keep on increasing the amount of dosage to get the same hit off of it. And that's what the Fed's doing with the economy. They're going to eventually get to a place with all of this free money down the road when they start pumping more liquidity in, that they are going to overdose the economy and kill it if they haven't already done so.
All right. So in more immediate terms, a huge drop today. This is Wednesday. What's ahead for the next week in the stock market?
Well, funny that you just mentioned that. So usually, if you look at margin debt right now, that's money that hedge funds and investors and speculators have borrowed money to invest in the stock market. So the money's basically borrowed money. The issue you have here, if you look at where margin debt's at right now, margin debt is about 30 to 40% greater than where it was before we had the big sell-off in 2020. Okay. Mm-hmm. What that tells me is we have a long ways to go in getting margin back down, or more selling pressure. And what happens when you have days like today, you get hit with margin calls. So if you borrowed money to buy stocks and your stock goes down, the brokerage firm will say, hey, you've lost some of our money. You need to make up what you've lost. If you borrowed $1 million from us and you lost $500,000, you need to come up with an additional $500,000 to give to us to make up for the loan. So what you're going to see is here in the next 3 days, you're going to see another big sell-off as hedge funds start liquidating those positions to meet those margin calls. A lot of times when you have a big sell-off like this happens on a Wednesday, margin calls have to be settled within 3 days. So a lot of hedge funds or brokerage firms require that to be done before the weekend. That's why they call the Friday after a big Wednesday sell-off as Free Fall Friday.
So a big sell-off, again, translated, means more dip in the stock market.
Yes.
So
yes.
How much lower will it go? The Dow already lost 1,100 points today. By the end of the week, how many points will be down beyond that?
We'll probably only lose a few more 100 points this week, but between now and my target level, I'm thinking the S&P will probably drop around 3,400 to 3,500 here in the next several months.
All right. So, so beyond next week, this week, next week,
Yeah.
in several months, what happens?
Well, and that's the funny thing is right now we are starting to enter the worst performing months of the year. So you've heard those saying sell May, go away, come back again Halloween Day. Between May 1st and October 31st, historically, that is the worst performing 6 months of the year. And if you really want to break it down, it really comes down, I guess the saying should be sell the last week of August and come back around sometime in the middle of October. That's my saying, but it doesn't rhyme. It doesn't sound as cool as sell May, go away. But what I'm getting at there is we now have entered the worst performing months of the year. And between now and September, those months keep getting worse and worse, with September being the absolutely worst performing month of the year for the stock market. Just to add a little history on that, we had 9/11 occurred in September. We had Lehman Brothers occurred in September. So I refer to the window between the end of August through roughly the middle of October as the jinx window. But also the jinx window had the 87 stock market crash in it. So it's just going to get a lot worse between here and there.
Before it starts recovering early next year and eventually goes back up into a bull market early next year.
Well, correct. Well, the reason why the stock market is going to rally up next year is because I am anticipating the Federal Reserve will either stop raising interest rates in roughly March of next year, or cutting interest rates even in March of next year, to fix the problem they have caused with the recession. Usually the stock market, because the stock market looks 4 to 5 months into the future, the stock market will start rallying up 4 to 5 months before the Fed actually cuts interest rates, if that kind of makes sense.
All right, so that would put it where it starts rallying.
If the Fed starts cutting interest rates in March, that puts your rally or your bottom somewhere around October of this year, which is also interesting because historically, as I mentioned earlier, this is a midterm election year. The stock market historically falls in a mid-year election, and the mid-year elections in November. So you're going to start getting a bottom somewhere in that same time span from the stock market spelling a rate cut in the first quarter and the midterm presidential elections for the House and Senate being over. That kind of all means.
All right, Mark, before we get too complicated about this, for the layman and myself, explain now the timeline here. Now you're saying for the next week or so, the stock market's going to be going down more, and for some time after that, but then it'll start picking up. So let's go through the timeline step by step. What happens for the rest of the week and then after that?
Right. So as we mentioned with the margin calls, you're going to get hit with the margin calls for people, having to sell stocks to meet the margin calls on where they borrowed stocks on borrowed money.
Yeah. Bought
stocks on borrowed money. They're going to basically, that's going to cause the stock market to fall off a little bit. You may get a little bounce up, here next week. Markets never fall in a straight line. The 1930s was a perfect example. It took 3 years for the stock market to fall 80%, but it was not a straight line down. And in this situation, it's not going to fall 80%, at least not for a few more years out. We'll see probably little bumps up, but the general trend of the stock market will be down between now and roughly the end of the year. And the only reason why it's going to probably bottom out towards the end of the year is because the stock market will start to anticipate the Fed will either stop raising interest rates or will actually start cutting interest rates sometime in the first part of the year. Now, where the catch comes in at, if the Fed does not stop raising interest rates and adding liquidity back into the economy on that time span, the stock market will continue to sell off until that event actually occurs.
But you're betting from past patterns with the Fed that around October, the market will anticipate that the Fed early next year will start easing up on interest rates, and therefore in October of this year, the turnaround will start.
Correct. And that historical pattern, hedge funds place bets on where they think things are going to happen, a year, 2 years down the road. Right now, where hedge funds are positioning themselves are in the euro dollar futures. It's basically the spread between where the euro trades at and the US dollar trades at. Based on how those contracts are currently trading in March of next year, those future spreads are trading as if the Fed is cutting interest rates. So that tells me that people that trade those markets are anticipating a Fed, are placing real money on this bet that the Fed will start cutting interest rates in the first quarter of next year.
Okay, so therefore, with that anticipation, the market will bottom out around October of this year. So in other words, it's going to be continuing getting worse and worse until October of this year, correct?
Correct. And the main culprit behind that is the Fed is very focused on inflation right now.
Okay.
So when the inflation data comes out, it always spooks the stock market because inflation keeps going higher and higher, meaning the Fed's going to have to be more and more aggressive on the raising interest rates.
All right, well, how low will it go then between now and October?
I have a price target of about 3,400 to 3,500 on the S&P, which is about another roughly, let's call it another 15 to 20% below where it's currently at.
And in the Dow and NASDAQ?
Well, the NASDAQ will probably fall a lot more. I'm actually anticipating at least another 20 to 25% decline in the NASDAQ. And I'm only
because that's tech heavy. That's
tech heavy. Yep. Tech stocks really hate inflation, so they get hit harder than other things.
right. And the Dow?
The Dow, I'm only anticipating maybe about a 15% decline because it's not as tech heavy. It has a lot of more tangible items in it, like, Coca-Cola, Caterpillar, but tangible items hold up a lot better in inflation than non-tangible items.
But still, overall, a further significant drop before October of this year.
Correct.
All right. Then in October, if past patterns prove to be repeated, it'll be the beginning of a recovery towards a bull market by when in next year?
Well, the bull market will anticipate the Fed cutting interest rates or not raising interest rates. And that's the key thing. If the Fed does not start adding liquidity back in the market and we get in the same scenario as we did in 1980, the 1980 recession is the recession that made Jimmy Carter lose his re-election bid against Ronald Reagan.
Right.
And even after Jimmy Carter left office, you still had a stock market and an economy that really kind of struggled for the next 2 years because the Fed kept doing the same things that caused Jimmy Carter to lose the re-election. They kept doing that after Ronald Reagan came into office. The thing that actually helped Ronald Reagan get reelected was the Fed actually started cutting interest rates in 1982.
So what you're saying is, in October of this year, the market should start recovering in anticipation that the Fed will be cutting interest rates early next year.
That's correct.
And that will occur next year, the rise in the market towards a bull market, unless the Fed fools everybody and doesn't cut interest rates next year, and then we'll have a continuing recession.
That's correct. And this is actually going to turn out to be an inflationary recession versus previous recessions, which are more deflationary.
So is that worse or better than the other recessions?
Inflationary recessions are worse because the consumer's getting hit twice. The higher interest rates and the higher inflation rate is taking money out of the consumer's pockets at two different ways.
Okay, so again, there is some question about how it's all going to turn out, but you would say, based on past economic patterns and actions of the Fed, it'll bottom out around October of this year. That is, it reaches its lowest point before the recovery starts at the end of this year, and then starts rising early next year, correct?
Right. Yep.
All right, well, that is a wrap. Mark Collinsworth of Vere Global Financial Management, and we'll be keeping an eye on the markets with Mark as we go along in the weeks ahead. So, Mark, thanks once again for being with us. Thanks.
Right. Thank you. Okay, thanks.